Hey everybody, it is Tuesday, August the 2nd, 2022. This is Danilo Bogdanovic, Realtor and Principal Agent with Redfin. Checking in with you guys. Wow, what a year so far. We're in month 8. So we've already gone through the first half of the year. Now we're in month 2 of the second half of the year. And what has been going on? A little bit of everything. So to sum it up, the crazy sellers market, arguably the craziest one in US history, ended around May. Since then, we've kind of been going sideways, some up, some down, more down than up in certain regards. Not that the market's crashing at all. I'll go into more detail in a second. And just the general economy, I think, people are a little bit wary. And then also, there is seasonality to real estate. And August is one of, if not the slowest month of the year in real estate, followed very closely by December. So for things to slow down as of July 1st is absolutely normal. Typically we see it in the healthiest of markets. That's for a variety of reasons. I know some areas may be a little bit less seasonal than others, but for this area it's very seasonal. So that's where we're at right now. People are always asking, oh, what's the market like? What's the market like? Well, I'm seeing some prices in certain areas tick down a little bit. I'm seeing other areas where they're still going up. Overall, in general, what I'm seeing in Northern Virginia is that they're going sideways. But here's the big difference. Instead of, a home being listed for, you have to, bid $800,000 on a house, but no home inspection, no appraisal, no financing contingency, no home warranty policy, and then, or you might just buy it as is, and then you move in and you find out that there's $20,000, $30,000 worth of stuff that needs to get done. That isn't out of the ordinary. It is an extreme. I'd say the average, is anywhere from a few thousand to 10,000, depending on the size of the home. But there are definitely homes that did need $20,000, $30,000 worth of work that you as a buyer, A, didn't know about, or B, if you did, you just sucked it up and said, I'm still gonna buy it. So I'm seeing home inspection contingencies again. I'm seeing appraisal contingencies again, financing contingencies, termite, sellers agreeing to pay for it. It's not being sold as is. So you may still get the same amount because the market values are kind of going sideways as a gross sales price as a seller, but you're actually netting less because now you have to pay for home inspection repairs before you didn't. So that's one big difference that doesn't really come out in the numbers. When you see the numbers for values, those are going by gross sales prices. They're not taking into consideration, hey, there were $2,000 worth of home inspection items, or 5, or 10, or 20. That is not part of the data. That is only back end in the MLS under concessions, and that's if the agent, which they should, puts it in the MLS and then makes a note about the concessions. For example, the note might say home inspection related or seller subsidy related. But that's not, those numbers don't come through. And what you see as far as, home values are up, down, or flat, that's not included. But the real feel is that buyers are actually paying less because there's less chance of them paying for items to fix on the back end, and sellers are making less because now they're paying for these things because they're being negotiated due to a contingency. So, but that's okay. That's a normal market. And normal in a market is better overall long-term. This crazy market was good for only one person. That was the seller who already had a second home that they were moving into and they've already bought it, or they were literally selling their second home, which was an investment or rental property. They weren't buying as well. Anyone who was selling or buying, it was a wash. And anyone who was just buying was just frustrated and demoralized. So overall, this is good. It's normal. We're looking for appreciation that keeps up with inflation, if not beats it. If inflation is supposed to be around 2%, maybe 3%, and we're appreciating at 3 to 5%, you're ahead of the curve, good long-term investment. That's kind of where I personally believe we should be for the long term. Not to say that's, as a seller, I wouldn't mind making 20% return in a year or 2 years. Of course I would love that. But that's only good for me short term. It's not good for the overall housing market. Where are interest rates? So interest rates have actually kind of plateaued also, right around the mid-5s. They bounce up and down, this and that and the other. There is some talk of them potentially going up higher. One big thing, which I mentioned before, and veteran lenders will echo this, the Fed fund rate is not a direct correlation to mortgage rates. It is for car loans and credit card APRs. But lenders and banks, they were way ahead of the Fed. They were where they needed to be, where the Fed was not. And interest rates started going up in end of December. Then they went up again. And then by the time the Fed increased their rates, the mortgage rates had already gone up from high 2s to high 5s. And now they're in the mid-5s. So what the Fed does is loosely, has loose effects on mortgage rates, but that's because of the general economy. The Fed's increasing the rate because of the general economy and inflation, and so do lenders, because interest is a direct correlation to risk. How much risk is there for lenders? The more the risk, the higher the interest rate. So that's where they are now. Could they go up? Yes. But for right now, they're stable, which is another reason why I think values are generally going sideways. Keep in mind that typically the second half of the year, we do see a slowdown in the market just due to seasonality, and also a slight adjustment down in price sometimes. So to see prices come down a little bit between now and the end of the year is not out of the ordinary. It's not something that I would be alarmed about. I would just see it as normal market cycles. So that's where we're at. Also wanted to talk about a couple things that I've seen come out that are topics that I'm hearing from clients. Number one is people have been noticing the news about cancellations by buyers when they're already under contract, being high at 14.9%. That statistic came out a couple weeks ago. That is above average, but not by much. And it's also relatively huge compared to what it was in 20 and 21. Almost no one was backing out of offers in 20 and 21, because if they did, they'd have to pay 3% more next month for the same house, if they could even find a house that they won an offer on. They might have to submit another 10 offers before theirs got accepted. So very few buyers were backing out. And very few buyers had any contingencies to back out on. I mean, unless you bought in an HOA, at least in Virginia, that was, if you bought an HOA in Virginia, but everything else was contingent free, that was your only way out. Now you have contingencies you can back out on. And some sellers are still stuck in that old market, and they're like, well, I accepted this home inspection contingency, but I don't agree with this. I'm not fixing anything. And then the buyer says, well, you accepted this offer with a contingency. I want these things fixed, either fix them or I walk. And the seller is still stuck. So you have two folks, not coming to an agreement, much more now than it was before. And that's why I think we're seeing a tick up in the buyers canceling their contracts. Interest rates really haven't spiked in the last month, month and a half. They spiked earlier. So that's not a factor currently. It might have been 2-3 months ago. And depending on the state, in Virginia, settlement's typically 30 days. So once you ratify, you send the offer to the lender, and the lender locks in the rate. So even if rates spike up a point, you're still locked in at that lower point. Now in New York or some other states where it could be 6 months of escrow, that's a different story. I can't speak for other states. I'm only licensed and an expert in Virginia. I'm not an expert or licensed in other states. But in Virginia, that's not a huge factor. New construction though, D.R. Horton just released some numbers, interestingly enough, that their cancellation contracts are up to 24%. That's high. Now, with new construction, the interest rates makes a big difference, because that home might not be ready to what's called be delivered for another 6 months, 9 months, maybe even longer. So you may have signed a purchase contract at this point. You might have signed it when it was still, 3.2, right around 3, possibly even in the 4s if it was very early spring. But now the interest rate's mid-5s, maybe a little bit higher for you depending on your credit. So now you're saying, ooh, this doesn't make sense for me long term. And you may lose your earnest money deposit that the builder would surely want to keep, but that earnest money deposit may actually be less than what your increased mortgage payment would be over the life of however long you plan on being there, whether it be 10, 15, 20 years, or you may not even qualify anymore. Now, builders don't usually give you a financing contingency. You have to be approved in 7 days, and then once you're approved in those 7 days, if something happens between that 7th, 8th day and settlement 9 months from now, you may be SOL. So they're very builder-sided. They're not very buyer-sided. So, don't want to go down that rabbit hole, but be very careful with new construction. If you want to talk more about that in detail, I'm here to talk about that anytime. So that's where we're at now. What to expect? I think we're going to see a very slow August. Buyers are both skittish due to rates and just general economy and all the negative talk and possible, war with Ukraine. Now we have this Taiwan-China thing going on with flyovers of Chinese jets. There's so much uncertainty right now. I think a lot of buyers are just kind of pulling back, but also it's August. At least in the DMV, this is the time of year where people go on last minute vacations, hurrahs, school starts very soon for a lot of people. So there's a lot of other things on people's minds besides buying a home right now. Typically mid-September, we see buyers come back out. And that's what we call the quote unquote fall market. It's nothing like the spring market, but it's more of a plateau and a slight increase in buyer demand, which is why the plateau happens. And that typically runs from mid-September to just after Halloween. Then, people are back to thinking about holidays, Thanksgiving, Christmas, all the holidays, and just very slow time of year, also due to weather. So that's what I think we'll see for the rest of the year, barring any crazy, war, stock market crash. And when I say crash, I mean true crash, not decline. Barring something like that, I think we're going to see a fairly normal market for the rest of the year, which is good for buyers. Some sellers would say, I don't like that. I want a seller's market. But overall, it's healthy, and it's not bad for either side. It's not bad for sellers. It's not bad for buyers. There are pros and cons to both, but it's healthy. So that's where we're at. Also wanted to give a big shout out to Zach and Lydia. I ran across your Jeep card that you gave me once again. That was very, very cool. Hope you guys are doing awesome, enjoying Colorado. Hope you got some skiing or snowboarding in this season. You had quite a season. And absolutely, next time I'm out there, I will hit you guys up and say hello. So hope you're doing well. Thanks again. Want to give you a shout out. All right, guys, enjoy the rest of your Tuesday. Have a wonderful week and try to stay cool this month. It's going to be a hot one. All right, talk to you later.